Happy New Year. Today is Friday, January 2nd, 2026. We hope you had a wonderful holiday season. Today we're going to look at the stock market 2025 in review, and we're going to spend a lot of time looking at some of the economic data. And without crossing the line and giving any forecast for 2026, because we just don't believe in giving forecasts, we're going to close the video today with what we think might very well be happening. Again, if you've been following us for any length of time, you know forecasts don't mean anything to us. We follow price action. It doesn't matter what we think is going to happen. What's important to us is what is actually happening. That said, I would be remiss if I didn't highlight the fact that just recently I learned that my book has won an award. My book is now a Literary Global Book Award winner. So if you haven't gotten a copy of the book, you can get it at Amazon. You can also get a free chapter, the free introduction and first chapter at theodorehicks.com. Again, that said, let's just go ahead and dive in and look at the main indices for 2025. On the screen, I've got 4 ETFs. I've got the MAGs, which is basically the Magnificent Seven, and the green. I've got SPY, which is an ETF that is going to be the proxy for the broad S&P 500, but it's going to be the cap-weighted version. And the equal weighted version of the S&P 500 is right here, RSP. And then I've got IWM, which is the Russell 2000 or smaller company stocks. And so there's 2025 in review, but I'm going to show you that some of these numbers and some of those returns are a little bit deceptive. One of the things we've been talking a lot about is this concentration risk. Remember, the S&P 500 is not the market. The S&P 500, as is frequently reported in the news media, is cap weighted. That means these top 10 stocks have a very large influence, almost 40% to be exact. So 40% of the S&P 500's return is going to be dictated by the top 10 stocks. There's your top 10 stocks, how they performed in 2025. But now let's do a little bit of math. Here are those top 10 stocks. Here's their weighting in the S&P 500. And then here is their 2025 return. How does that translate to the S&P 500? Well, again, what that means mathematically is these top 10 stocks delivered a 10.5% rate of return, and so it effectively contributes 63% of the S&P 500 return was generated from just those top 10 stocks. The other thing that we have been talking a lot about these last several months is this divergence. Now, this slide is from my friends over at Motor Capital Management and Dave Lundgren, and this slide technically is from November. I'm going to give you the updated version, but as a recap, remember in the top pane is the S&P 500, and you can see the green arrows representing a somewhat positive trend. The bottom pane is the value line geometric average. As a reminder, the value line geometric average is looking at about 90% of the US stock market, and it is equally weighting every stock in that index, but it's also rebalancing that on a daily basis to come up with, and it gives a very good indication of the breadth of the market. So how's the overall market? Is it healthy or is it not? Well, you can see the negative trends in the value line. So let's take a look at and update that value line. This is now through the end of 2025. And what I really want you to see is that for the most part, the value line geometric average did not really go anywhere last year. Matter of fact, it was up 2.84%. So this is a key point when you think about 2025. When you look at the value line geometric average, that index was up only 2.84%. The S&P 500, yes, it was up approximately 16%, but we've already shown you and reminded you that it is cap weighted. The value line is a better indication of how the average stock has done. And in 2025, the value line geometric average was positive 2.84%. In our fixed income models, we're using the Schwab Money Market Fund for a portion of that, and that fund was yielding more than 3% all year long. Sometimes part of the year was even above 4%. So the average stock in 2025 actually underperformed a decent money market fund. Now, again, if you look at the value line geometric average, just look at that red line. The thinner red line represents the 200-day moving average, and look how flat that line is. Now, one of the things we'll come back to at the end of the video is that we would contend that this is a base. And one of the cliches in the technical analysis community is the longer the base, the higher in space. So I'm not going to make any predictions, but the fact that we have moved sideways for so long with the average stock, unless there's an economic breakdown, that's actually potential good news for 2026. We're going to transition now and start looking at some of the economic data, but we're going to start by looking at GDP. And recently we got the third quarter GDP, and a lot of commentary was around the fact that it was a lot stronger than most people expected. But was it? One of the things I like to talk a little bit about is how the GDP calculation is actually derived. GDP is calculated by consumer spending plus investment spending plus government spending plus net exports. Think of it this way. If Ted Hicks buys a computer for his wife, that's consumer spending. If Ted Hicks buys a computer for his staff, that's investment spending. Government spending is somewhat obvious, but net exports is really where we need to spend a little bit of time. Now, before we even talk a little bit about that, I want to relate the fact that the GDP calculation was created in 1937 by this gentleman, and it was designed to help measure the economy during the Great Depression. I would certainly argue that the economy has certainly changed since 1937. A lot of countries use this calculation. I'm going to argue that it is flawed in logic. Let me explain why. So if we return to the calculation, I really want to hammer home why I believe this net exports component of this GDP calculation is faulty. Remember, if we import more than we export, net exports is going to be a negative influence on GDP. And in fact, when you look at the data, that's exactly what the data tells us. Remember, this calculation, GDP, was contrived in the 1930s, and for a long time, it didn't really pose any problems. But really, since the 1970s and even the 1980s, our nation really started to change, and we started to import more than we exported. And as a result, you hear more and more politicians talk about our trade deficit. That's what they're talking about. This negative influence, we have a trade deficit because we are importing more than we are exporting. But does it really matter? Well, think about it. When you go to your grocery store, I'm willing to bet you've got a trade deficit with your grocer, because you walk in with cash or piece of plastic and you leave with groceries. But I'm willing to bet your grocery store has never once hired you for your products and services. So you technically have a trade deficit with your grocery store, but does it matter? No, it doesn't matter. The trade is a fair trade. They got the cash, you got the groceries. And so when you hear politicians talk about our trade deficit and the fact that it's not fair or something cockamamie like it's irrelevant. It doesn't matter. The problem is net exports is a part of the GDP calculation, and you can see it has a negative influence on that calculation. Now, remember what happened last year. Last year, the first quarter of GDP was technically negative. And then remember, this third quarter, we heard all these pundits say it was stronger than expected. Well, remember what was going on. What was the number one economic news from 2025? Tariffs. Well, what happened? Well, you can see if we go back to this net exports, this massive change here, that was companies anticipating the tariffs. And so what a lot of companies did is, instead of spreading out their imports, they accelerated their imports into the first quarter. That's why first quarter GDP was slightly negative. And so the second and third quarter was a little bit stronger because that they had already done a fair amount of their imports. So it looks like the economy is fairly robust when you look at it and this measure. But again, dive into the data and actually look at this imports. This again is from the Federal Reserve's economic database, and you can see our imports. There is a fairly consistent trend. That is a positive trend in terms of imports. The only time you see the imports really decline is when we are going into a recession, or we are already in a recession. Otherwise, our imports historically are more than our exports, and so it's impacting that GDP calculation. Now, the other problem with the GDP calculation is it is only counting final production. For example, when you buy a car from Ford, that is included in the GDP calculation, but when Ford buys the steel from Alcoa, that is not included in the GDP calculation. So there's a lot of problems in that GDP calculation. I would argue this one, gross output, is a much better way to measure the economy. This was created in 1990, and it's really measuring the entire economy as opposed to just the final production. But really, we have to look at that negative trend that's been in place for quite a while. Now, I'm going to argue that I think we're more likely to see this trend reverse, and I'm going to come back to that in just a minute. Okay, so now I'm going to really start to burn through some of this data quickly, so hang with me. The first thing I want to talk about is the second Fed mandate. Remember, they have two mandates. One is stable prices, so inflation. The second mandate is about employment and maintaining full employment. The main point is there is definitely some concern that the unemployment rate has been rising since August of last year. We've talked about this in some of our videos. The job openings has really come down since that major post-COVID spike. We built this little base. The most recent tick has been a tick higher in the right direction. Personally, I'd like to see this move even further out. Now that we're into the new year and after the holidays, I wouldn't be surprised if this begins to move higher. In concert with this, when we look at the layoffs, yeah, you hear about layoffs every once in a while in the news, but you really got to look at the data. So has it ticked higher? Yes. Has it ticked higher in a meaningful fashion? No, because when you look at the history, we are now at the levels that used to be the lows. So layoffs are not a concern in my book. If you live in North Carolina is strong. We are holding steady at 3.7. I think that's one of the lowest unemployment rates in the nation, if I'm not mistaken. This is housing starts. And so we've been talking a little bit about this, that we really need to see this negative trend broken. Obviously, with the cut in the Fed funds rate, that's going to impact, it already has impacted mortgages. And so we would expect to see the housing sector of the economy start to do a little bit better. But we also know there's some seasonality with this. The home buying season usually starts in March. And so I wouldn't be surprised if this starts to turn back around as well. The next thing I want to do is show you the consumer confidence survey. And I would argue that this is a contrarian signal, okay? Because this is the most recent update, and you can see there's only been one time where we have been lower than the current level. And usually when consumer confidence reaches levels like this, that's actually a contrarian indicator. And so I think that is good news. So let's now look at some other components that I would argue are good economic news. First up is gas prices, and you can see this trend, but I put in this base. The reason I mark up my charts is so I can see easily, and we just recently fell back through that. So gas prices have been going down. Obviously, that goes into transportation costs and shipping. I would argue that is good news. The other thing I'd like to talk a little bit about is household debt service payments. This is basically debt. As the average American consumer able to service their debts, has it risen? Yes, it has. The most recent update is that it's ticked back lower. But again, look at the level as it relates to history. I would argue this is very positive news. If we look at the delinquency rate on credit cards, again, has it elevated from the COVID lows? Naturally, but it has also ticked back down, number one. Number two, we are below the lows from history. So I would argue that is good news. Consumer debt service payments also historically low and has ticked right back down. And remember, this is as a percentage of disposable income. So I know I went through that fairly quickly, and there's a lot of slides I decided to take out simply because of the length of the video, but I want to wrap it up and show you the number one reason why I believe it is fairly unlikely that we will see a recession in the near term. And then we're going to roll that back into what we're seeing in the stock market and ultimately I believe that suggests positive news for 2026. So what is the number one reason why I believe it is unlikely that we will see a recession in the near term? And it's simply because it seems that everybody is prepared for a recession. Remember what I just showed you about debt service payments and how everybody seems to be paying their debts on time. Well, now take a look at this data. This is cash, all commercial banks, the cash holdings at all commercial banks. This data is cash assets that are reported from quarterly financial reports from corporate America. So this data suggests that corporate America is holding a lot of cash, and this data suggests that the average American consumer is holding a lot of cash. As financial planners, we encourage you to hold cash to weather any economic storms. That's what seems to have been happening. So I have a hard time envisioning a recession occurring because it appears that everybody is prepared for a recession. I take that tidbit of information and I overlay it with the value line geometric average. Remember, what this is telling us is that the average stock has really just gone sideways. Yes, we had that tariff drawdown in the first part of the year, and that kind of scared a lot of people. And I think that's why you have a lot of both companies and individuals hoarding cash to the extent that they can. Well, they've recovered, but we really haven't broken out. They haven't really begun to thrive. As interest rates have come down, that's going to start to change what we see. And again, as I indicated, the longer we see something like this happening, assuming there's no external economic shock, it seems to me more likely that the trend is going to break out and break out higher. And when we look at the Russell 2000, the smaller companies, I start to see some additional signs of encouragement because we were able to break through this. This did support. This pullback here recently has been relatively orderly. And when we look at the volume, this pullback right here towards the tail end of 2025, it occurred on very low volume. So what that's telling me is that there's not a lot of convincing action. It's not being pulled back on heavy volume like you saw over here. There's a lot of volume on this pullback. The volume is confirming that pullback. The volume is not confirming this pullback. And so I believe there's more likely a chance that we will see a positive trend and move back higher. The last thing I would show you is the U.S. composite leading indicator is in a positive trend. So ultimately, yes, the S&P 500 was up 16% last year, but the average stock was barely positive. And as I showed you, the average stock actually underperformed a decent money market fund. But while that's not a sign of a robust economy, that's last year. And I suspect what we might very well see is a little bit of more positive trends for the average stock in the new year. Again, not a prediction. That's just the way that I see it. If you know us, we follow price. It doesn't matter what we think is going to happen. We're going to follow price and execute according to that. Obviously, if you have any questions, by all means, send me a DM or reach out to any member of my team. Thanks for watching, especially all the way to the end on this one, and Happy New Year to you all.